That $12,000 deduction is sitting right there on your new tax form. And you probably felt some relief when you heard about it. Finally, Congress actually did something for people who earned this money and paid into the system their whole lives. But April is almost over, and your bank account doesn't look any different. Here's what most people don't realize until they sit down with their actual tax bill. There's a separate calculation the IRS runs before any deduction ever enters the picture. It's called Provisional Income, and it has nothing to do with the $12,000 they just gave you. Provisional income works like a gatekeeper. It looks at what you pulled from your IRA, any interest you earned, half of your Social Security check, and it makes a decision. Are you the kind of retiree who gets to keep your benefits tax-free? Or are you the kind who quietly hands 85% of those benefits back to the IRS as taxable income? That decision happens before your $12,000 deduction shows up. By the time that deduction gets to do anything, the damage is already done. Back in 1984, when Congress set the income thresholds that trigger this tax, about 10% of Social Security recipients got hit. They never adjusted those thresholds for inflation, not once in 40 years. So today, nearly 1 in 2 retirees is paying tax on their benefits, and most of them have no idea why the math doesn't work out the way they expected. In the next 20 minutes, I want to walk you through the exact formula the IRS uses, the one your tax software calculates but rarely explains, and why the anger a lot of people feel about being double taxed is actually pointing them in exactly the wrong direction. Let me introduce you to Bob. Bob retired last year at 64. He gets $30,000 a year from his pension, and he pulled $20,000 from his traditional IRA to cover some home repairs and a trip he had been putting off for years. He heard about the new $12,000 senior deduction and figured he was in decent shape. He did not touch his Social Security yet, still delaying to grow the benefit. His tax software ran the numbers. The result surprised him. The formula the IRS uses for provisional income looks like this. Take your adjusted gross income, add back any tax-exempt interest you earned from municipal bonds, then add 50% of your annual Social Security benefit. That total is your provisional income. And that number is what determines how much of your Social Security gets taxed. Not your deductions, not your filing status on its own, not how long you worked. The thresholds are the part that really stings. For a single filer, if your provisional income lands between $25,000 and $34,000, up to 50% of your Social Security becomes taxable. Above $34,000, that number jumps to 85%. For married couples filing jointly, the brackets are slightly wider, $32,000 to $44,000 for the 50% tier, and above $44,000 for the 85% tier. Those numbers were written into law in 1984. They have never been adjusted for inflation, not in 4 decades. I've watched this trip up people who are genuinely careful with money, people who did everything right. The problem is not that they made bad decisions. It is that the system was built at a time when very few retirees had significant IRA balances. That world no longer exists. Back to Bob. His provisional income calculation looks like this. $30,000 from his pension, plus $20,000 from his IRA, plus 50% of his Social Security benefit. Even before he collects a single full year of Social Security, the combination of his pension and IRA withdrawal alone pushes him well past the $34,000 threshold. The result, 85% of whatever Social Security he eventually collects will be taxable income. The $12,000 senior deduction comes into play later, after that determination has already been locked in. Now here is the part that catches almost everyone off guard. Say Bob decides to pull just $1,000 more from his IRA. Maybe the furnace breaks, maybe it is a grandchild's birthday. That $1,000 does not just add $1,000 of taxable income. Because he is already in the 85% tier, that extra withdrawal drags an additional $850 of his Social Security benefits into taxable territory alongside it. So $1,000 decision becomes $1,850 of taxable income. That effect has a name. It is called the tax torpedo, and it hits hardest in the years right around when people first start collecting benefits. Feeling confused by this is not a sign you missed something in school. The IRS worksheet for calculating Social Security taxation is 18 lines long. It is genuinely designed for a spreadsheet, not mental math. The fact that your tax software just hands you a number without explaining the sequence, that is not an accident. That is just how complicated this got when 4 separate legislative patches were stacked on top of each other over 40 years. According to the Social Security Administration, in 1984, roughly 10% of Social Security recipients paid any tax on their benefits. In 2026, that number is approaching 50%. The income thresholds did not move. Retirement account balances, pension income, and part-time work in retirement all grew. The gap between what Congress intended and what retirees actually experience has been widening quietly ever since. That is the mechanism. Not malice, just math that was never updated to match the world it now applies to. When the new senior deduction was announced last year, I'll be honest, my first reaction was relief. I thought about several clients I'd been working with, people right at the edge of that 85% bracket, and I thought, this might actually help them. I went looking for the mechanism. I wanted to understand exactly how it would interact with provisional income. What I found was not what I expected. The $12,000 senior deduction is a below-the-line deduction. That means it reduces your taxable income after your adjusted gross income has already been calculated. And provisional income, the gatekeeper we talked about, is calculated from your AGI. So by the time the $12,000 gets to do anything, the IRS has already decided what percentage of your Social Security is taxable. That decision is done. Locked. The deduction does not touch it. Think of it this way. Your Social Security benefit walks up to the gate. Provisional income checks the number, stamps it 0%, 50%, or 85% taxable, and waves it through. The $12,000 deduction is standing on the other side of that gate. It can reduce the total tax you owe on everything that came through, but it cannot go back and change what just got stamped. For someone with modest income, say Social Security plus a small pension and very little IRA activity, the deduction can still provide real relief. If your provisional income keeps you below the lower threshold, most of your benefits were already tax-free, and the $12,000 helps reduce tax on the rest of your income. That is a genuine benefit for that person. But for the retiree with a traditional IRA balance, a pension, or part-time income, the profile that describes a large portion of people in their late 50s and 60s who saved consistently, the sequence works against them. Their provisional income already cleared the 85% threshold before the deduction was ever calculated. The $12,000 shaves something off the final tax bill, but it does not reduce the amount of Social Security that got pulled into taxable income in the first place. It is a little like getting a coupon after the price has already been set at the worst tier. The coupon is real. It just does not fix the underlying pricing problem. A married couple, both 66, combined Social Security of $42,000, a $28,000 pension, and $15,000 in annual IRA withdrawals, runs a provisional income of roughly $64,000. They cleared the 85% threshold by a wide margin. About $35,700 of their Social Security becomes taxable. The $12,000 senior deduction reduces their overall taxable income, which is meaningful. But $35,700 of their retirement benefit is still in the taxable pile. The deduction did not change that number by $1. That is, the sequence the legislation does not advertise. I do not think this was designed to deceive anyone. Laws get written in pieces, layered on top of older laws, and the interaction between them is rarely explained in the press release. Most people heard $12,000 deduction for seniors and filled in the rest with reasonable assumptions. The assumption was wrong, but it was completely understandable. What matters now is that you know how the order of operations actually works. Because if you are making decisions about when to take Social Security, how much to pull from your IRA, or whether a Roth conversion makes sense, all of that turns on provisional income, not on the deduction. The $12,000 is a real number that reduces real taxes. It is just not the number running the show. Everything we have talked about so far assumes a relatively stable situation. Two people filing jointly, drawing benefits on a predictable schedule. But there are two scenarios that quietly make this worse, and most retirement planning conversations never bring them up. The first one is the widow's penalty. When one spouse passes away, the surviving partner does not just lose part of the household income. They also lose their filing status. They go from married filing jointly to single, and the provisional income thresholds drop with it. The upper bracket for a married couple sits at $44,000. For a single filer, it is $34,000. That is a $10,000 gap, and it does not come with any adjustment period. It applies to the first full tax year after the death. I've been close to situations like this more than once, and the financial shock tends to arrive at the worst possible moment. The household income often drops. One Social Security check goes away or gets reduced, but the tax exposure on what remains can actually go up. A woman I'll call Linda lost her husband 2 years ago. Her own Social Security benefit, his reduced survivor benefit, and a modest IRA withdrawal put her provisional income at around $38,000 as a single filer. As a married couple the year before, that same income profile would have kept them in the 50% tier. As a single filer, she cleared the 85% threshold. Her federal tax bill on Social Security income jumped over 40%. In the first year, she filed alone. She was not reckless. She had not changed anything. The category changed around her. This is one of the reasons Roth conversions done before, either spouse stops working, can matter so much. Pulling money out of a traditional IRA before you need it, when both of you are still here and filing jointly, can shrink the IRA balance that would otherwise force larger withdrawals later, when the thresholds are narrower and the household has less margin. The second scenario is geography. Most people know the federal government taxes Social Security. Fewer realize that some states do too. As of 2026, 8 states still tax Social Security benefits at the state level. West Virginia was on that list for a long time. They officially removed Social Security from state taxation earlier this year. That matters if you live there, and it matters if you are deciding where to retire. The 8 states still taxing benefits each have their own thresholds, exemptions, and phase out rules. Some only tax above a certain income level. Some exempt benefits entirely after a certain age. The details vary enough that a general answer is not very useful. What matters is knowing your specific state's treatment before you finalize any withdrawal or conversion strategy. If you are in one of those 8 states, your effective tax rate on Social Security income is a combination of federal and state exposure. The federal formula is complicated enough on its own. Layering a state tax on top of it, with a different set of thresholds, means your provisional income calculation alone does not give you the full picture. Location is not a minor variable here. For some people, it is worth hundreds of dollars a month. The double taxation argument is one of the most common things I hear from people in this age group. And I get it. You worked for 40 years. Every paycheck, 6.2% came out before you ever saw it. That money went to Social Security. And now the government wants to tax the benefit you get back? It feels like paying for the same thing twice. That feeling is legitimate. I am not going to tell you it is wrong to be frustrated, but here is what that frustration is actually costing you. Because there is a factual piece of this that changes the math. The 6.2% you paid out of your own wages, that money was taxed. You are right about that. It came from your after-tax income. But your employer matched that contribution dollar for dollar. Another 6.2%. Paid on your behalf every year you worked. That employer contribution was never part of your taxable income. It went into the system quietly, without you ever paying income tax on it. So when the IRS taxes up to 85% of your Social Security benefit, they are not taxing the same money twice. They are, at least in part, collecting tax on the employer's side of the contribution that was deferred for decades. Is that a clean or satisfying explanation? No. Does it make the tax bill feel better? Probably not. But it reframes what is actually happening, and that reframe matters more than it might seem at first. I am not in a position to judge anyone's frustration here. I have sat across from people who built genuinely modest retirements through decades of careful saving, and watching a portion of that get reclaimed by the IRS is hard to watch. I feel that too. But here is the behavioral piece that concerns me more than the tax itself. When people are anchored to the double tax framing, they tend to make a specific mistake. They avoid pulling money from their IRA, or they delay Roth conversions because every withdrawal feels like another round of being taxed on money they already earned. The anger at the system bleeds into inaction on the strategy, and inaction has a price. A traditional IRA that sits untouched through your early retirement years does not stay neutral, it grows. And at age 73, required minimum distributions kick in whether you want them or not. At that point, the IRS sets the withdrawal schedule, not you. Those forced withdrawals push up your AGI, which pushes up your provisional income, which pulls more of your Social Security into the taxable column. The tax torpedo hits harder because the balance is larger. The retirees who manage this well are not the ones who found a way to beat the system. They are the ones who stopped arguing with the system long enough to work inside it. Your job is not to win the moral argument about whether this tax is fair. Your job is to keep as much of your retirement income as possible. Those are two different objectives. Only one of them you can actually control. Strategy without a target is just motion. So before anything else, know your number. Run your provisional income calculation for this year. Not an estimate, the actual number, and find out exactly which tier you are in and how much room you have before you hit the next threshold. That number is the foundation everything else builds on. Once you have it, there are 3 moves worth understanding. The first is Roth conversion, and the timing is everything. If you have a traditional IRA and you have not started collecting Social Security yet, you are sitting in what is probably the most valuable window you will have. Your income is lower, your provisional income is lower, and every dollar you convert from a traditional IRA to a Roth now is a dollar that will never show up in your provisional income calculation again. Roth distributions are not counted. They do not move the needle on your gatekeeper number. The strategy is not to convert everything at once. It is to convert up to the edge of your current bracket. Stop before you push yourself into the next tier. And do it consistently over several years before benefits begin. The goal is to shrink the traditional IRA balance that will eventually force required minimum distributions at 73. A smaller RMD means a lower AGI, which means a lower provisional income, which means more of your Social Security stays out of the taxable column. A client of mine shifted the timing on a $40,000 IRA withdrawal by about 14 months, pulling it before his Social Security start date instead of after. Same dollar amount, different sequence. He saved enough in federal taxes that year to cover the payments on a new electric vehicle. Not because he found a loophole, because the order of the transaction changed what the IRS counted and when. The second move is the Qualified Charitable Distribution, or QCD. If you are 70 and a half or older and you give to charity, this matters. A QCD lets you transfer money directly from your IRA to a qualified charity, up to $105,000 per year in 2026, and that amount is excluded from your AGI entirely. It satisfies your RMD requirement without the withdrawal ever touching your taxable income, which means it never touches your provisional income either. For someone who is going to donate anyway, the QCD is one of the cleanest tools available. You give the same amount, you just route it differently. The charity gets the same gift. You keep a lower AGI. The third move is withdrawal sequence, which account you pull from and in what order. The general principle is this: taxable brokerage accounts first, traditional IRA second, Roth accounts last. Pulling from your brokerage account first generates capital gains income, which is typically taxed at a lower rate than ordinary income and does not increase your AGI in the same way a traditional IRA withdrawal does. Preserving your Roth for last means that money continues to grow tax-free and, critically, never contributes to your provisional income when you eventually draw it. Here is a rough comparison. Two retirees, same Social Security benefit of $28,000, same total annual spending of $55,000. Retiree A pulls the difference entirely from a traditional IRA, $27,000 withdrawal. Provisional income lands near $55,000. About $23,800 of Social Security becomes taxable. Retiree B pulls $15,000 from a brokerage account and $12,000 from a Roth. Provisional income stays under $35,000. About $8,400 of Social Security becomes taxable. The difference in federal tax on Social Security income alone is roughly $4,500 to $5,000 for that year, and it compounds forward as long as the sequence holds. Same income, different order, very different outcome. None of this requires a dramatic overhaul of your finances. It requires knowing your provisional income number, understanding which tier you are in, and making deliberate decisions about where each dollar comes from. The system is not going to change in your favor. The thresholds are not getting adjusted. But the sequence, that part is yours to control. If you want the actual worksheet I use to run this calculation, subscribe. I share working versions of these tools every week, not theory, the actual numbers. Everything in the previous section assumes the world stays roughly where it is today. But there is a stress test worth running, because one variable could make all of this significantly worse, and it is already in motion. Inflation. The provisional income thresholds, $25,000 and $34,000 for single filers, $32,000 and $44,000 for married couples, have not changed since 1984. Not once. Meanwhile, Social Security benefits themselves are adjusted for inflation every year through the cost of living adjustment. Pensions, in some cases, carry inflation riders. IRA balances grow. Part-time income in retirement has become more common, so the benefits go up. The thresholds stay flat. Every year, more retirees cross into the 85% tier without changing a single behavior. If inflation runs at 4% annually for the next 10 years, the math gets uncomfortable quickly. A retiree who is sitting just below the upper threshold today, managing their withdrawals carefully, staying in the 50% tier, could find themselves pushed into the 85% tier by 2035 through nothing more than annual KOH law increases on their Social Security check. They did not pull more from their IRA. They did not take on part-time work. Their benefit just grew with inflation, and the threshold did not move with it. The SSA projects that without any legislative change to those thresholds, the percentage of Social Security recipients paying tax on their benefits will continue climbing through the next decade. That is not a prediction about tax policy changing. It is arithmetic about fixed numbers in an inflationary environment. Now run the same scenario for someone who spent the last several years doing Roth conversions before their benefits began. Their traditional IRA balance is smaller. Their required minimum distributions at 73 are lower. When they calculate provisional income, the Roth distributions they are drawing do not appear in the formula at all. So even as inflation pushes their Social Security KOH law higher each year, their provisional income stays anchored, because the income they are living on is coming from sources the formula ignores. They are not immune to inflation. Their grocery bill went up like everyone else's, but their tax exposure on Social Security did not compound the way it does for someone still drawing primarily from a traditional IRA. That is the difference a few years of deliberate conversion can make, not just in the current year, but across a decade of rising prices and frozen thresholds. The system was not designed with this scenario in mind. It was designed for a retirement landscape that no longer exists. Your strategy has to account for the one that does. You came into this video having heard about a $12,000 deduction. You are leaving it knowing that the deduction is real, and that it arrives after the decision that matters most has already been made. Provisional income is the number that runs the show. It determines how much of your Social Security benefit gets pulled into taxable income before any deduction, any exemption, any credit gets a chance to help you. That calculation has not been updated since 1984. It was not built for a retirement landscape where most people have IRAs, pensions, and Social Security all arriving at the same time. The anger about double taxation is understandable, but it is pointed at the wrong target. The employer's share of your Social Security contribution was never taxed. That is what the IRS is collecting on. Knowing that does not make the bill disappear, but it frees you up to stop fighting a moral argument you cannot win and start executing a financial strategy you can. The moves are not complicated. Know your provisional income number. Convert traditional IRA balances to Roth before your benefits begin, up to the edge of your current bracket. Use qualified charitable distributions if you are giving to charity anyway. Pull from your brokerage and Roth accounts before you touch the IRA. Control the sequence. Retirement is not the time to fight the IRS. It is the time to make sure they cannot reach the money you worked 4 decades to build. If this video helped you see something you did not see before, share it with someone who is still operating on the assumption that the $12,000 deduction solved the problem for them. It probably did not. And the sooner they know, the more options they have. I am Wes. I am here every week with the actual math behind the decisions that matter most in retirement. Subscribe if you want to stay ahead of it.